Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical performances. With the S&P at a crucial technical spot for its current rally, the next 2 weeks are one of the most pinnacle times in its history. With the soft inflation report, S&P futures rallied amidst a major dovish shift in sentiment, seeing rate hike expectations come down somewhat significantly. However, with geopolitical controversy re-escalating, will this bullish CPI report be enough to continue the bull run going, or are we in for another grueling pullback? This morning at 8:30 a.m., our inflation rate data came out and shocked the markets as we saw inflation below consensus and forecasts at 3.5% versus the 3.8% expectation, the lowest number we've seen since the pandemic. The market had an extreme dovish shift in Fed rate expectations. As you can see today, probability of a rate hike dropped 24.1% to 16.6%, making a hold in rates the much more likely outcome and suggesting a bullish shift in sentiment amongst investors. We saw the S&P and NASDAQ rise 40 basis points and 1%. However, just because the CPI report was bullish does not mean we are in the clear of a pullback, as tensions in the Iran conflict are continuing to rise, and it's in question how much of a shock to inflation the recent developments in Iran will cause. Oil futures rose an additional 2% today on top of the 8% yesterday amidst the developments. It was reported that Iranian forces struck 3 commercial vessels overnighting in retaliation of recent U.S. strikes on their naval base. And it didn't end there, as more reports are coming out as the day goes on further attacks on U.S. military bases in Kuwait. While Trump met with Iraq's prime minister today, he stated in the meeting,
I wanted to give them a chance at making a deal. You know, we had a deal 2 days ago. It was done. And then all of a sudden, they couldn't do it. They didn't like something about the deal. They couldn't do it. And they shot first, and that was a big mistake that they shot first because we have been knocking the hell out of them.
Which shows that this conflict de-escalating in the near future seems pretty unlikely. To add even more to an eventful morning, to say the least, Kevin Warsh testified in front of Congress today on the state of the U.S. economy. He repeatedly made it very clear that he's committed to keeping politics and the Fed separate, in which he ensured that his vision of the Fed is one that does what the data suggests is best for the American people and not what the current administration pressures for. He stated that he believes the labor market and growth is in a good place, and the focus remains on tackling inflation at the moment. And while he acknowledged the favorable inflation report this morning, he emphasized that one good report does not mean their job is finished, and that inflation is no longer a risk. In other words, he is emphasizing caution as he knows, like the rest of us, geopolitical tensions are certainly not getting better at the moment, and oil supply shock is certainly not helping our issues with inflation. It is now in question how much of a shock the recent developments in Iran will cause to inflation numbers, if any at all. With that being said, while these inflation numbers bail us out from the bloodbath momentarily, the rate in which this conflict has been re-escalating could certainly lead into a re-acceleration of inflation. However, until we have data to suggest that is the case, it should not lead our decisions as an assumption. Nobody knows what's going to happen in the near future, so remaining cautious on both sides of market sentiments is the best policy at the moment. Tomorrow at 8:30 a.m. we have PPI coming out. Now this is also a really big number to pay attention to because this will confirm to us if inflation is cooling off because companies are taking the brunt of inflation impacts, or if inflation in general is actually cooling off and both producers and consumers are experiencing a drop in inflation. Then on Thursday, we have retail sales, which will give us an updated picture on consumer confidence on the economy. A healthy economy likely implies citizens with disposable income to use and confidence. However, generally, whenever people are worried about the economy, they tend to spend less and prioritize saving for a rainy day. If you are a bull, you want to see retail sales outperform expectations, as that will show strong consumer confidence and that consumers are still actively driving sales. We also have initial and continuing jobless claims coming out Thursday, which will give us an updated snapshot of the strength of our labor market. Generally, you want to see jobless claims down and inflation down, as those are staples of a good economy. If we see the labor market remaining resilient, plus inflation cooling off, that could be bullish for markets. However, bear in mind, a sign of too much strength will likely further encourage the narrative of a holds longer or room for a hike if inflation does in fact reaccelerate. While the conflict in Iran is important, a big focus for investors the next 2 weeks is going to be major earnings coming up. With banks reporting this week, we already saw Bank of America and JPM stock prices benefit from earnings beats. This Thursday, a really big earnings for the S&P is Netflix, given it's one of the largest market cap stocks in the index and has been falling under the pressure of valuation crunch and profit taking to make room for cheaper multiple options. We talked about a signal for Netflix yesterday using the 14-week RSI. Go check that out if you're curious to see more details around its historical performance of the trigger. If we continue to see great earnings reports like we saw for banks, this could be great for the S&P as long as our concerns on inflation remain low and signs of inflation cooling off continue. All right, so let's jump a little bit into some S&P price action. Over the past couple days, we've been talking about this bullish breakout of a triangle in which you can see highs are closing in and lows are also closing in. So generally, whenever you see breaks like what we saw on July 6th, oftentimes this implies you're going to go on to test your pivot highs that were created along the way of your triangle. And so as you can see, when we broke out, we went on to retest this trend line and it continued to validate this breakout because notice this major rejection wick we bought right back above and closed back above the trend line. So we talked about how it was likely we see a bounce out up to the 78.6, and if we closed above our 78.6, it was likely we went on to retest our pivot high here labeled as B. Now, given, yesterday we had some bearish news and sentiment, as well as, some just nervous anticipation for CPI coming out, we did see some selling back down into 78.6 and 61.8 zones. Just as a refresher, this is our retracement levels from our drop from roughly June 2nd down to June 9th. And so this yellow zone can be a really good confirmation area. Whenever you break above the 78.6, right, this generally implies we're probably going to go on to retest these pivot highs again. And if you break below 61.8, then it's very likely that we go on to see 7300s again, similar to like what we saw on June 16th. Now, with the bullish CPI data that came out this morning, we did see a bit of a buy up outside of the 78.6 region and closed back above it. So generally this is bullish, and we can still consider 78.6 a support. And until we start trading back below it, it's implied that we're going to go on to retest B again. Now, should we go ahead and break B, right, this brings in our upper targets at 76.45 and 77.53. Now, I got these targets by creating a retracement from B to C, and the 1.236 and 1.618 retracements are typically what the move calls for on D whenever you break the swing high at B. So the first stock I want to talk about is CF, and the indicator you're seeing on the screen here is an indicator called Trender. And what this does is it uses a measure of volatility called ATR to form bands around the price. Now, whenever you see breakouts of these ATR bands, that generally assumes you've shifted environments and it's likely to go on to continue trading in that direction. Now, for CF, we've seen 14 bullish ATR crosses in the past roughly 7 years, in which the price rose on average about 23% over the next 120 trading days, or just about 6 months. Of those 14 historical triggers we're seeing, the price was higher about 86% of the time when looking at that 120th trading day out. Relative to its sector, it performed about 19% on average over that 6-month period, and relative to the index, it outperformed about 16.8% on average. It's currently performing at a profit factor of just under 9. So that means your wins are just about 9 times larger than your losses on average. And so ultimately, if it were to continue to perform at that profit factor, and this strategy was only right 10% of the time, you would break even. So performing at an 86% win rate is more than profitable historically speaking. And so we had our most recent trigger just today, 714. And so it'll be interesting to see over the next 6 months if we do achieve that average return of about 23%. Taking a look at CF's reactions, on the x-axis we have days out from the trigger, and on the y-axis you have cumulative percent change. So in other words, what you're viewing here is what your returns would be if you had bought CF on each one of the buy signals and held for 120 trading days. So in blue, we can see the average lead up to that just about 23% on the 120th day. And in yellow, you'll see current active triggers that are occurring, right? So we had a signal back on May 12th in which it performed very closely in line with our min return historically. And notice we tended to get a bit of a bump up, at least in terms of our min return. And generally speaking, from this standpoint on, this is when our average really begins to pick up and close in closer to about 20% on average leading into the 4th month out from these signals. Now, in terms of drawdown risk, there is some significant downside risk in which you're seeing at times it's gone down about 20% relative to the trigger price. In this case, on the May 12th trigger, it did in fact go down about 21.6%, right, and has been climbing up since. Ultimately, this is why stop losses are going to be very important to help mitigate losses and just protect your downside. But ultimately, relative to the upside, the downside is fairly minimal, right? We're seeing upside potential of about 40 to 60% on some of the most extreme returns versus, about 20% to, let's say, 16% on the downside risk, for example. Just want to clarify, just because history has shown a certain performance, this does not guarantee that this time around you'll see the same performance, right? So again, that's why risk mitigation is very important, as this isn't some crystal magic ball that's right every single time and you go all in on every single trigger, for example. So if CF were to achieve that roughly 23% on average, that would bring it up to about $146 a share leading into January 4th of next year. I also put a 7.7% stop loss to respect a 3-to-1 ratio. However, you can always structure your stop loss however you want, as long as it's palatable to your risk structure and makes sense with your investment style. Now, a few things I want to point out here that's fairly bullish for CF. One, notice we had a very strong bullish break back in March of 2026. And generally, whenever you have strong breaks above, peaks, when you come on to retest it, this is often a very strong pivot point that investors like to buy more or get back in if they took profits higher up above the break. Also notice we've been trading in a pattern called a bull flag, right? So that's when you have a very steep and uninterrupted incline, right? And then you have a declining parallel channel on the way down, and ultimately it's building structure to go on further whenever you break above the top of the flag. And so similar to any other trend line break, whenever you break trend lines, it implies you go on to test the pivot highs that were created along the way. Right? That brings our first upward target about $128 a share to $130 a share. And if we do breach through this resistance zone, then ultimately that brings our next resistance zone about at 136 to 142. Should we break this last resistance zone, ultimately this would call for what's called a green line breakout. And that's when, I believe this is its all-time high. Yeah, so that's when you have an all-time high that is realized, and then you have 3 months of consolidation, in this case a bit longer than 3 months. And when you go on to break that all-time high, you call that a green line breakout, and oftentimes it applies for the bull run to go on further, right? So if we did go on to break this resistance zone, that 23% on average is fairly likely, and maybe even more. And if you want to look more into green line breakouts, it's pioneered by Dr. Eric Wish at University of Maryland. So the next stock I want to talk about is JPM or JP Morgan, which recently had a very strong earnings report, which they beat estimates. And so the same strategy is signaled off for JPM as well. Ultimately, trenders often paired with very strong news that drives up volatility and breaks the price out of a typical range it will trade within. And so in this case, we saw another signal for JPM. And whenever JPM experienced bullish ATR crosses, it jumped about 13.5% on average over the next 86 trading days, or just about 4 months and a week. So a bit shorter than the typical 6-month period you'll see in some of these optimized strategies. So of those 6 historical triggers over the past 7 years, 83% of the time the price was higher. We just had our most recent trigger today, 714, and ultimately this trigger has been performing at a 6.8 profit factor, meaning its wins are about 6.8 times larger than its losses on average. So if it were to continue to perform at that profit factor, and this strategy was only right 12.8% of the time, you would break even. Taking a look at JPM's reactions to those trender signals, on the x-axis, again, you have trading days out from the signal, and on the y-axis, you have cumulative percent change. So what you're viewing is what your returns would be over time if you had bought JPM on each one of those trender buy signals. In blue, we can see it lead up to that 13.5% on average on the 86 trading day. And in particular, there was one really bad reaction in the last 6-month period in which drew the average down. So ultimately, if we never had a reaction like that, your average would be a lot higher, and maybe the optimal or peak average duration based off history would have been a bit longer, right? But essentially, because of that one, reaction, our peak occurred on the 86th day out from our trigger. Not to say 86 will be the best duration to hold off this signal for perpetuity of following this strategy, but based off history, that's what the reactions show. 86 days has tended to be the best optimal holding period based off those 6 reactions. And as you can see, we just had our 7th trigger today. There is no orange line because we're on day 0. As the days go on, a yellow line will begin to populate on this chart. In terms of drawdown risk in the first 3 months, right, we saw drawdowns of 7%, 4%, and 4.5% at its worst. Excluding this big drop that occurred in that last 100 to 120 day period, right? So there's really relatively small downside risk to upside risk when looking at historical reaction. So if JPM were to achieve that roughly 13.5%, that would bring it to about $389 a share leading into November 12th of this year. On the downside, it put a stop loss of about 4.5% to respect a 3-to-1 ratio. However, again, you can always set a stop loss however you like. It's really up to you. So also went ahead and plotted some price action in which we've seen JPM kind of play out the same situation over and over again in recent times, and I kind of highlighted that with arrows here. And so first, whenever you have a resistance zone that it rejects off of, and you come back on later to break it, right? It's just similar to that concept of green line breakout. You have a resistance, you have a long-standing situation where it consolidates underneath and then breaks back above, right? Same thing here. We had our resistance zone that developed, right? And then for just roughly a month in this case, we broke through, right? And that's a bullish cross above the resistance. Same thing, right? We built our resistance zone here, and notice when we came back to retest that same resistance zone that we broke before, it's now support, so it bounces off, right? So oftentimes after breaking resistance, coming back to it, this is a great pivot point to go on to the next stage in your bull cycle, right? So we had it happen again, right? Our resistance zone developed, we had our consolidation underneath for a couple months, and it broke through. Right? What happened when we came back down to it? bounced off, right? And now we just had another bullish break above our resistance zone here. And so in particular with JPM, what I'm noticing is it's, you know, kind of played out the same style of price action over the past roughly, let's say, 3 years, right? So last thing I want to point out in terms of watching out for risk, right? If it rejects here and starts trading back below this resistance zone, this could potentially mean, right, maybe we're going on to retest this trend line here that developed and broke. So ultimately, right, we had a trend line break, and whenever you break, it implies you go to test the pivot highs along the way. So that's what we went and did. And so ultimately, maybe you come back down to test this trend line. We have another trend line, a support that's developing, and so in this triangle breakout, if you will, right? So that was our triangle breakout. And ultimately, say you come back to reject it and come back down, maybe it comes on to retest this trend line or retest the support line further up here, right? So the third stock I want to talk about is ticker TKO. And the indicator that triggered this time around is called stochastic RSI. So in the first panel, we have its price over the past roughly 3 years. In the second panel, we have what's called RSI, or Relative Strength Index. And in the third panel, we have what's called stochastic RSI, which is a derivative of RSI. And essentially, it tells you when RSI is gaining momentum itself, right? And RSI tells you when price is gaining momentum, right? So ultimately, with stochastic RSI, generally speaking, when you're below 20 and then you get a bullish cross between the two smooth moving averages of your stochastic RSI, that's your buy signal. So I can zoom in a little bit to show you, right? So when the white crosses above the yellow and you're below 20, that's typically, you know, a stochastic RSI signal. Oftentimes, too, you can wait until it crosses back above 20, both the stochastic and the smoothed series of it. Right, it's really up to you how you want to use stochastic RSI. But in particular, how I set up the strategy, it's whenever RSI is below 40 in this case, and we get that stochastic bullish cross under 20. Now, we've seen 19 of these signals in the past 3 years, in which the price rose on average 25% over the next 118 trading days. Of those 19 signals, 95% of the time, the price was higher when looking at that 118 trading day out. Relative to the sector, it outperformed about 15.5% on average across those 19 triggers, and relative to the index, about 16.25%. Now, this is one of the highest profit factors I've ever seen when working with event studies. I've been studying event studies for over 5 years now. And generally, this is one of the highest profit factors I've seen, where this is telling you that your wins on average were 68 times larger than your losses on average. And generally speaking, that's because the times when you did lose, it was just about break even by the time you got to the 118th trading day. We had our most recent trigger today, 7/14, so it'll be interesting to see over the next 118 trading days how TKO performs. So if TKO were to achieve that 25% on average, that would bring it to about $231 a share leading into December 31st of this year. On the downside, it put about 8.36% stop loss to respect to 3-to-1 ratio. I also went ahead and plotted some major support and resistance zones currently that it's trading within. The biggest one being currently around 176 to 184, we'll say. It jumped into there briefly, and today it bought right back out, similar to what we were seeing in May of this year, as well as November of last year. All right, so if you start seeing price continue to trade upwards, and especially if it starts breaking through the MAs again, this could be a good indication that we're going on to retest some of these resistance zones above. Something I want to bring to your attention in terms of bearish risk, right? So we recently broke a long-standing trend line to the downside, right? Notice we've been developing it since roughly August of 2024. And so whenever you have a very long-standing support or resistance, with multiple pivot points. The more points you have, the stronger the break is, right? So this could imply going all the way down to retest some of these lower pivot points if we start breaking back below this current support zone or we're trying to bounce off of. So just bear that in mind. Not to say it's guaranteed we're going to start going to these lower support zones, right? But if you do start seeing it close through, chances are we may see it, right? So the fourth stock I want to talk about today is ADI, in which an indicator RSI and also MACD signaled a buy. So as you can see in the top panel, we have price over the past roughly 3 years. In the second panel, we have RSI, and in the third panel, we have MACD. Now, generally speaking, what this buy signal calls for is whenever RSI's average is below 48.5 and it crosses over its own moving average. Alongside MACD also has a bullish cross. Once you see white cross above the red, it fires off a buy signal. Now, every time ADI has had one of these buy signals, it rose 21% on average over the next 120 trading days. So across the 24 historical triggers we've seen over the past 3 years, the price was higher about 96% of the time. In terms of profit factor, it's performing at about a 7.7 profit factor, meaning its average wins were 7.7 times larger than its losses on average. And so we recently had our 25th trigger, I believe, and 26th trigger on July 10th and July 14th today. And so it'll be interesting to see over the next 6 months what ADI is able to achieve. Taking a look at ADI's reactions to those RSI plus MACD triggers, in blue we can see it lead up to that 21% on average on the 120th trading day. And we have four active triggers currently. 2 of them fired off on March 24th and March 31st. And as you can see, they jumped upwards of 40% in the first 3 months and 36% in the first 2 months. Currently, they're both performing above 20% right now, so they've already outperformed the average in just under 3 months. That's a really good sign that maybe we continue on to see a similar return the second half of these reactions to some of our max returns historically. So if ADI were to achieve that 21% on average, that would bring it to about $475 a share leading into January 4th of next year. Now, a few things to point out here. It's been bouncing off a major support line since November of 2025, right? So we're currently bouncing off of it a second time. Should we continue to see, a breakout past these current highs in the consolidation, that especially a close above, that could be a really good sign we're going on to test the top resistance zone here. Ultimately, if we do break below our trend line, as well as the base of our consolidation here, and our if you want to call it fair value gap, then ultimately that brings our attention and targets down to the downside to these swing lows that were created along the way. Ultimately, with how history has, or based off of historical returns, we know it's far more likely to see prices closer to break even or above come January 4th of next year. However, that is not a guarantee that the price will be higher, right? There's still a chance that it can be lower or, ultimately end up a loss, for example. And for the downside risk, right, to respect a 3 to 1 ratio, it's about a 7% stop loss. So that's everything for today. If you enjoyed the video, please give it a like and subscribe, and I hope to see you in the next one.